Welcome to the Deep Dive, the show where we take a stack of sources, articles, research, and our own extensive notes and really dig into them. We extract the most important nuggets of knowledge to get you truly well-informed fast.
That's the goal.
Today, we're plunging into a topic that, well, at first glance, it might seem a bit abstract, maybe, but trust me, it underpins so much of what goes wrong in our increasingly complex world.
It really does. It's everywhere once you start looking.
Exactly. From, spectacular financial meltdowns you read about to those frustratingly consistent project delays we all experience, we're talking about fragility. That hidden vulnerability that lies just beneath the surface of systems that seem, well, pretty robust. And it's particularly insidious when things scale up dramatically, get really big, or when we fall into that trap of relying too heavily on simplified averages.
That's right. And our mission in this deep dive is to truly unpack the insidious nature of fragility, which is, by definition, the exact opposite of resilience or robustness. It's about brittleness. We'll explore how it's often camouflaged, maybe by sheer size or by our relentless drive for efficiency, and definitely by our over-reliance on metrics that, frankly, tell only part of the story.
Just the highlights, maybe the misleading highlights.
Precisely.
Oh.
We'll extract key insights from the sources you've provided, focusing on why some things break so disproportionately under stress, why size is so often a vulnerability rather than a strength counterintuitive, maybe, and how our common understanding of averages can be, well, dangerously misleading.
Dangerously misleading. I like that.
And importantly, we'll try to arm you with some practical ways to maybe detect this hidden fragility, potentially saving you from costly surprises in your own life or work.
Yeah, it's all about those fundamental aha moments, isn't it? The things that will fundamentally change how you view everything, from like major economic events unfolding on the news to just understanding why your next big project might be heading for a costly overrun.
Exactly. These aren't just abstract concepts.
No, this deep dive isn't just theory. It's a crucial understanding for navigating a world that's becoming, let's face it, increasingly interconnected, complex, and frankly, unpredictable. So let's unpack this and dive right into the perils of scale. Where do we start?
Well, to truly grasp the hidden dangers of size, maybe let's cast our minds back to January 21st, 2008, a specific date.
Okay, 2008, what happened?
It was Martin Luther King Day in the U.S., a public holiday. Now, that meant markets were exceptionally thin, very little trading activity happening. Quiet day.
Right, low volume.
Suddenly, out of nowhere, a massive unannounced sell-off hits the global markets. A major Parisian bank, Société Générale, was absolutely forced to execute what was basically a fire sale.
A fire sale on a holiday.
Yes, rushing to offload nearly $70 billion worth of stock.
Yeah.
The market, already quiet, just couldn't absorb it. It reacted violently, dropping by almost 10% worldwide.
Wow, 10% globally from one bank's actions.
From this one frantic event, and it cost Société Générale an astounding $6 billion in losses.
Yeah.
$6 billion from one rapid, forced sell-off. It's a staggering figure.
$6 billion? That's hard to even picture. What on earth forced them into such a drastic move on a quiet day?
Well, what's truly fascinating here, and this is the core insight, isn't just the size of the loss, but the why. The underlying cause and the disproportionate effect. The bank couldn't wait. They were caught completely off guard, blindsided, and forced to sell immediately. No choice.
Why? What happened?
They had uncovered a monumental fraud orchestrated by a single back-office employee, a guy named Jerome Kerfield.
A back office guy, not some high-flying trader.
Nope. Kerfield, in essence, had been hiding humongous unauthorized trading positions and exposures from the main computer system. The bank didn't even realize they effectively owned these stocks, or that they had such a massive hidden exposure to market fluctuations.
So they were sitting on a time bomb they didn't even know existed.
Exactly. It was an internal meltdown that demanded immediate, drastic action. Dump everything now.
And here's where that non-linearity of loss becomes so strikingly clear, which I think is a powerful lesson for all of us, right?
Absolutely.
A $70 billion fire sale led to that $6 billion loss.
Right.
But our sources point out something critical. If the sale had been just 1/10 the size, say $7 billion.
It's still a huge amount, but much smaller relatively.
Right. If it was $7 billion, the market likely would have absorbed it without any significant panic, maybe without even a noticeable blip. The result? Effectively, no loss at all.
Zero loss, potentially.
So this isn't some linear equation where 1/10 of the cause equals 1/10 of the effect. Not even close.
Far from it. Precisely. This immediately tells us that large, concentrated actions can have these disproportionately negative effects. Think about it. if instead of one monolithic bank with a single rogue trader like Curfew.
One huge point of failure.
Yes. Imagine we had, say, 10 smaller banks, each conducting its own proportionate trading independently, maybe at different times, spread out. The total loss across all 10 banks would likely have been close to nothing.
Because each small sale gets absorbed.
Exactly. Each smaller sale would have been absorbed by the market without causing that systemic ripple, that panic. The powerful takeaway from Société Générale isn't just about the fraud itself. It's this. Concentration of risk, even unintentional hidden risk, can trigger disproportionate systemic collapse.
So size itself becomes the amplifier.
It introduces this powerful idea that small is beautiful. It is certainly less fragile. It's not just about the absolute size you see, but how that size translates into concentrated, unmanageable risk when things go wrong.
That's a principle we can actually observe in everyday life, can't we? Even in something as simple as, say, a crowded movie theater or a bustling shopping mall.
Oh, absolutely. It's a great analogy. Imagine you're sitting in a packed cinema enjoying a film. If one or two people quietly get up and start walking hastily towards an exit.
You probably wouldn't even notice, or you'd just think, oh, restroom break, or they're leaving early, no big deal.
Exactly. No alarm bells. But now let's escalate that scenario. What if maybe 10 to 50 people suddenly get up and start moving quickly, purposely, toward the exits?
Okay, now that would catch my eye. My internal alarm bell might go off. I'd think, something's definitely wrong here. You start feeling a little uneasy, looking around, trying to figure out what's happening.
Right, you feel the shift. And this is where things get truly exponential. What if the entire theater, all at once, hundreds of people, suddenly gets up, maybe someone screams, and everyone starts running for the exits?
Oh, instant chaos, full-blown panic. Even if it's just a false alarm, maybe someone yelled fire as a hoax.
Doesn't matter. You've got chaos. People are potentially trampling each other, the exits are jammed, injuries are highly probable. The key point is, the initial small movements of just a few people don't trigger an exponential negative trade-off. There's no disproportionate harm.
It's contained.
But as the volume of people and the number of participants increase, as the situation scales up, the harm grows exponentially high. This isn't a linear relationship where double the people simply equals double the harm. It's way, way worse. It's a geometric progression. Small panics are often contained. Large ones compound catastrophically.
So scale magnifies the panic response disproportionately.
Precisely. And this concept, this nonlinearity of harm, it extends directly into the world of project management, which, many of our listeners probably deal with every single day.
Oh yeah, project delays and cost overruns, the bane of many existences.
Exactly. The sources demonstrate really firm evidence that an increase in the overall size of a project maps directly to poorer outcomes and, crucially, higher and higher costs of delays as a proportion of the total budget. It's a chronic problem, observed for decades.
Okay, so bigger projects just inherently go wrong more often or more expensively?
Well, there's a critical nuance here, and this is important. It's not simply the entire project size that matters so much as the size per segment.
Size per segment, what do we mean by that?
Well, think about projects like building a massive bridge or digging a new tunnel. These are often inherently monolithic, big single things.
Right, you can't build half a bridge easily.
Exactly. They cannot be easily broken into smaller, independent, and adaptable portions. You can't build a bridge one tiny isolated piece at a time and completely isolate errors. As a result, their percentage cost overrun and the likelihood of delays increases markedly with their overall size. They are, by their very nature, highly fragile. One problem stops everything.
Because it's all interconnected.
Absolutely. Conversely, consider projects like constructing a network of dams or building roads. These can often be designed and built in small, adaptable segments.
Like building a highway mile by mile.
Right. Project managers incur small errors, maybe one at a time, within these confined segments, and they can adapt to them, learn from them, correct course before they cascade into larger problems affecting the whole thing.
So errors stay localized.
Which means there's no serious role for squeezers, those situations where a small error in one tiny part brings the entire massive project to a grinding halt. Because they are modular, these types of projects show no serious size effect. The percentage overrun doesn't balloon just because the total length of the road is longer.
So the takeaway for project managers is pretty clear then. Break down large projects into manageable, independent segments whenever possible. Build resilience through modularity.
Exactly. Avoid the monolith if you can.
And this principle also applies powerfully to, say, local economies and even real estate development, right? I've seen arguments against these huge superstore chains coming in and acquiring entire neighborhoods, consolidating all the retail space into one massive entity.
Yes, there are compelling arguments there, highlighted by folks like British advisors Rohan Silva and Steve Hilton. The core risk, they point out, is that should such a megastore go bust, which, let's be honest, happens more often than we might think, the result isn't just a vacant storefront.
No, it's much worse.
It's a massive war zone, as they put it. You're talking about an entire desolate area, a blight on the community because all the economic eggs were put into one giant fragile basket.
That really underscores the crucial importance of including the probability of failure in any cost-benefit analysis, doesn't it? We tend to focus only on the upside, the advertised benefits. Maybe lower prices, convenience, efficiency.
The shiny brochure version.
Right. But we often ignore the hidden, disproportionate cost of having a single large point of failure. This logic actually favors small, independent merchants. It argues that small is beautiful not just aesthetically, but because it's inherently less fragile if one small shop closes.
It's a ripple, not a tidal wave. The system adapts. Our economic systems, just like our physical ones, thrive on distributed risk, not concentrated vulnerability.
And if we connect this to the broader global picture, we see how globalization, despite all its perceived deficiencies, has kind of had this unintended side effect, hasn't it? It's made contagion, well, planetary.
That's a great way to put it. It's as if the entire world has become one gigantic room with far too many people all rushing towards the same, very narrow exits. This concentration accelerates harm and makes us all much more vulnerable.
Can you give some examples of that rushing to the same exits?
Sure. Think about the cultural and economic homogenization that often comes with globalization. Everyone, seemingly, wants to read the same bestsellers like, say, Harry Potter back in the day, or join the same dominant social media platforms like Facebook now.
Creating monocultures of attention.
Exactly. And on an economic level, you see wealthy people globally converging on the same luxury items. The same vintage Cabernet wine, the same exclusive travel destinations like Venice or Florence, the same idyllic second homes in the south of France.
Making them less idyllic pretty quickly.
Precisely. The result, these once charming tourist locations become utterly unbearable, strained beyond capacity, losing the very essence that made them desirable in the first place. This concentration, this rushing to the same exits, is itself a massive source of fragility. The system can't handle the focused load.
And the ecological implications are equally profound and, frankly, concerning.
Oh, absolutely. Our contemporary habits often lead to excessive, concentrated use of specific products or resources. Think about the global demand for tuna, for instance. Extreme tuna consumption.
Right, driving species towards collapse.
This intense concentration doesn't just put pressure on a single species. It actively hurts entire ecosystems. And when that concentrated demand meets a finite or dwindling supply, what happens? You get disproportionate price rises due to shortages. We saw this pattern in the financial crisis, and we see it constantly in our resource markets.
It's the same fragility pattern again.
Contrast this with the ancestral wisdom of the Alats tribe, a North American native group mentioned in the sources. Their predatory behavior, surprisingly, exhibited a remarkable lack of concentration. They didn't hunt or fish a single resource to exhaustion.
They didn't put all their pressure on one spot.
No. Whenever their primary resources got low, they simply switched to another, less exploited one. It was an implicit understanding of these convexity effects. They instinctively knew that concentrating their pressure on one part of the ecosystem would lead to diminishing and eventually destructive returns.
So they preserved their ecosystem by distributing their impact, essentially managing risk.
Exactly. It was sustainable because it wasn't fragile. So what does this all mean for us today? It means that seemingly efficient centralization and globalization inherently create fragility by concentrating risk. We gain a superficial, often temporary, efficiency, but at the profound cost of robustness and long-term stability.
So the lesson from ancient wisdom is clear. Diversification isn't just good for your investment portfolio, it's essential for planetary health and human well-being. We need distributed systems.
Distributed and adaptable systems, that seems to be the key.
Okay, let's shift gears entirely now and talk about the asymmetry of error. This is fascinating. Have you ever noticed why planes almost never arrive early by any significant margin, but they're constantly arriving late, sometimes by hours or even days?
Oh, yeah. It's one of those things that's so obvious when someone points it out, isn't it?
It really is.
I've flown the London-New York route, I don't know, countless times throughout my life. It's roughly a 7-hour flight, give or take. And while I can maybe recall a few instances, literally a handful, arriving 10 or 20 minutes early.
Which feels like a miracle when it happens.
Right, it feels amazing. But I've had many, many more flights where I was 2 or 3 hours late, and at least one truly memorable instance where it took me more than 2 days to reach my destination because of cascading delays, weather, cancellations, the whole domino effect.
2 days. Wow.
Yeah. The core concept here is simple but profound. Uncertainty tends to cause delays. It makes arrival time increase. It almost never decreases arrival time significantly. Anything unexpected, any shock, any volatility, bad weather, mechanical issue, air traffic control, is far more likely to extend the total flying time.
It only pushes the arrival time to the right on the timeline, never really to the left.
Exactly. It even connects in a kind of profound way to the very irreversibility of time itself, doesn't it?
Yeah.
The idea that disorder naturally tends to increase. The powerful insight here is that uncertainty, by its very nature, adds time. It almost never subtracts it in any meaningful way.
And this isn't just about planes, is it? This principle generalizes to pretty much all projects you can imagine.
Absolutely. Just as adding uncertainty to a flight makes planes land later, not earlier, adding uncertainty to any project makes it cost more and take longer to complete.
Building a website, writing a book, constructing a skyscraper.
It applies across the board. Now, we often attribute this chronic issue project overruns to psychological biases, right? Things like the planning fallacy, where we're just too optimistic, or simple overconfidence.
Yeah, we can totally get this done in 6 months. Famous last words.
Exactly. But the deeper issue, as our sources reveal, isn't primarily a psychological problem, though that might play a role. It's inherent to the nonlinear structure of projects themselves, the way tasks depend on each other.
How so? The non-linear structure.
Well, consider a simple 3-month project. It simply cannot be completed in zero time or negative time, right? That's impossible.
Obviously.
So on a timeline, errors, delays, unforeseen problems consistently add to the right. They push the completion date further out, they add time and cost, they almost never add to the left, making the project finish significantly earlier.
Okay, that makes sense. Things can only delay it, not magically speed it up beyond a certain point.
Right. If uncertainty were truly linear, symmetrical, we'd expect some projects to be completed extremely early, just as often as they're completed late. But that's just not what happens in the real world, is it? Things are almost always late or over budget, rarely significantly early or under budget.
It's true. You almost never hear about massive projects finishing way ahead of schedule.
Which raises an important question, especially when you consider history. Many truly large-scale projects from, say, a century or more ago, think about the Empire State Building.
Iconic. Went up incredibly fast, didn't it?
Astonishingly fast. It rose to completion in just over a year. Or think about London's Crystal Palace, built for the Great Exhibition of 1851. These massive undertakings were often completed within budget, and, remarkably, sometimes even ahead of schedule. The Crystal Palace went from initial concept to grand opening in an unbelievable 9 months.
9 months. For
Yeah.
something that huge and innovative, that's incredible compared to today. So why? Why the historical success compared to today's chronic overruns?
Well, the sources suggest a few key differences. The Crystal Palace project, for example, didn't use complex computer modeling for every single calculation. Its parts were largely built from local sources, not reliant on these incredibly complex, fragile global supply chains involving a small number of distant businesses halfway across the world.
Less interdependence, fewer potential points of failure.
Exactly. There were no omnipresent project management schools churning out methodologies or consulting firms, which ironically can sometimes foster a false sense of control and actually increase overconfidence. In essence, it was a much more linear economy back then. Less complex, fewer tightly interconnected parts that could break down and create those cascading failures we see now.
So simplicity and local sourcing were actually strengths.
In terms of robustness, yes. Today's world, by stark contrast, is just riddled with more nonlinearities, asymmetries, and convexities. This isn't accidental. It's a direct consequence of soaring complexity, extreme interdependence between parts, unchecked globalization, and that beastly thing called efficiency, as one source puts it.
Efficiency is beastly. How so?
Because it makes people now sail too close to the wind. When every system is optimized to the absolute nth degree for maximum output with minimal buffer, minimal slack.
There's no room for error, no margin.
Exactly. It leaves no room for error. Add to that the pervasive influence of consultants and business schools maybe pushing these hyper-optimized models, and you find that one seemingly minor problem somewhere, a supplier delay, a software glitch, can hold up an entire vast interconnected project. The whole thing becomes as weak as its weakest link.
And everything is linked now.
Everything is linked. And interestingly, the problem of cost overruns and delays is in fact much more acute in the presence of information technologies. Large-scale computer projects seem to cause a disproportionately large share of these massive overruns.
That's counterintuitive. You'd think computers would make things more predictable.
You would think. But perhaps they enable a level of complexity and interdependence that becomes unmanageable and inherently fragile. The core insight here, I think, is that today's relentless pursuit of maximum efficiency often comes at the hidden cost of unforeseen and disproportionate fragility. We optimize for the best case, and forget the worst case can be exponentially worse.
That's a powerful point. And governments and wars provide even more, well, explosive examples of these dangerous nonlinearities and asymmetries, don't they?
Oh, absolutely. Tragic examples, often. Consider the Great War, World War I. It was initially estimated, widely believed that it would last a few months. Now the boys will be home by Christmas, a quick, decisive conflict.
Yeah, that didn't quite pan out.
Not even close.
Yeah.
Instead, it dragged on for 4 brutal years, leaving France and Britain, among others, heavily in debt, costing at least 10 times what they originally thought it would. 10 times. And the same pattern, tragically repeated with World War II. Initial underestimations followed by vastly larger costs and duration.
And more recent.
The Iraq War provides another stark lesson. It was expected, based on initial government projections, to cost up to $60 billion in direct military expenses. A lot, but maybe manageable.
And the reality.
Today, the total cost, when you include indirect costs like long-term health care for veterans, interest on the war debt, the costs of regional instability, it's estimated at more than $2 trillion.
$2 trillion from an initial estimate of $60 billion. That's an error of unbelievable magnitude.
It truly is. Complexity plus asymmetry, once again, led to explosive, almost unimaginable errors in forecasting. It truly underscores how spectacularly bad our models, our predictions are, at estimating the downside of these large, nonlinear events.
But governments, it seems, don't even need wars to get us into trouble with chronic deficits, right? The sources mentioned project overruns are endemic.
That's right. The underestimation of project costs is almost like a governmental golden rule. It's the norm, not the exception. Studies consistently show that a shocking 98% of contemporary government projects have overruns, and not just by a few percentage points, but often substantial budget-busting amounts.
98%, that's basically everything.
Pretty much. This chronic inability to accurately predict costs and timelines, combined with that nonlinear impact of unforeseen events, leads to persistent fiscal imbalance year after year. Our sources even cheekily suggest a governmental golden rule should be. Ideally, no borrowings allowed, forced fiscal balance.
A bit extreme, perhaps, but it highlights the scale of the problem.
It's a stark reminder that when it comes to large-scale endeavors, especially public ones, errors overwhelmingly accumulate to the downside. Things almost always cost more and take longer. We should plan for that asymmetry.
And this tendency for costs to balloon and errors to amplify isn't just in huge government projects or wars. It's profoundly evident in our financial systems, too, isn't it? You mentioned stock exchanges earlier.
Yes, exactly. Take stock exchanges, for example. They famously converted over the years from those open outcry systems.
Yeah, with traders yelling and waving their hands in the pits. Very cinematic.
Right. They moved from that to purely computerized trading systems. Now, the visible benefits promised were actually very small, maybe shaving off a few milliseconds from trade execution times. Tiny efficiencies.
But the risks?
The risks, as we've unfortunately seen, have proven to be massively large and hidden. While errors made by human traders are typically confined, they're distributed, often quickly corrected through social interaction, human intuition, someone noticing something weird.
Someone yelling, hey, that price is crazy.
Exactly. There's a human check. But errors made by a fully computerized system, they can go wildly out of control, spreading at machine speed across the entire network before anyone even realizes what's happening.
Like the flash crashes.
Precisely. We saw this with the terrifying August 2010 flash crash, where a bizarre computer error, maybe a runaway algorithm, caused the entire U.S. stock market to plummet by nearly 1,000 points in mere minutes. Billions in value evaporated instantly before partially recovering.
I remember that. It was shocking how fast it happened.
Then, in 2012, Knight Capital Group, which was a major trading firm, lost a staggering $480 million in just minutes because a newly installed piece of software went rogue, placing millions of erroneous orders. It ultimately led to the firm's collapse and forced sale.
$480 million in minutes. Gone. Because of code.
Yeah. So this isn't just about efficiency versus inefficiency. It's about the nature of error itself. Human errors are often localized, maybe messy, but contained. Algorithmic errors can be systemic, instantaneous, and catastrophic.
That really highlights the inherent dangers of naive cost-benefit analysis, especially when dealing with these complex, interconnected systems.
Absolutely. Consider France's historical focus on nuclear energy, for instance. On paper, on a spreadsheet, it seemed incredibly clean and cheap, maybe the optimal solution based on the models available at the time.
Looked good in the analysis.
But after the devastating Fukushima disaster in 2011 caused by an earthquake and tsunami in Japan, remember, an external shock, the French government, and indeed many others using similar reactor designs, suddenly realized they needed massive additional safety features, urgent upgrades.
Things they hadn't budgeted for.
Not at all. They scrambled to add them at any cost, because the perceived risk had suddenly changed dramatically. This enormous unforeseen expense was never part of the initial cost-benefit analysis that had made nuclear power look so appealing on paper.
The model didn't account for that kind of failure mode adequately.
Exactly. When deciding on one source of fuel against another or making similar large-scale comparisons, we often fail to realize that model error may hit one more than the other, and the consequences can be catastrophic. The initial assumptions we make about small probabilities of failure.
Like a 1 in 10,000 year earthquake hitting a nuclear plant.
Right. Those assumptions tend to be fragile themselves. They're prone to massive errors. That probability could potentially rise dramatically from, say, 1 per million to 1 per 100 in the face of new information or an unexpected event, rendering the entire initial cost-benefit analysis completely moot.
So the true cost of a system has to include the disproportionate impact of its potential black swan failures, not just its projected day-to-day efficiencies.
That's the crucial point. It's about recognizing that our models often fail spectacularly to account for the disproportionate impact of extreme, rare events, those tail risks, those highly unlikely yet utterly devastating possibilities.
Which brings us directly to the inverse philosopher's stone, as the sources call it. How do we actually detect this hidden fragility before a system collapses in spectacular fashion? How do we spot the vulnerability?
And this takes us to a really fascinating real-world case study. The Fannie Mae story. Remember Fannie Mae?
Oh, yeah. Huge U.S. mortgage company central to the 2008 crisis.
Colossal government-sponsored lending firm. Played an absolutely central role in the U.S. mortgage market. And as you said, it eventually collapsed during the 2008 financial crisis, costing U.S. taxpayers hundreds and hundreds of billions of dollars. A massive bailout.
A true behemoth that failed.
But the seeds of its destruction, the fragility, were visible years earlier if you knew where and how to look. In 2003, one expert received a highly sensitive, secret risk report from, essentially, a defector, a whistleblower from within Fannie Mae.
Wow, secret internal data.
Yes. This wasn't the public-facing sanitized stuff. This was the raw, unvarnished truth of their internal risk calculations, apparently hidden from regulators and investors.
So what did this secret report show?
Imagine the scene. A whistleblower, risking their career, maybe more, slipping this confidential report into the hands of an independent expert. The insight gleaned from that report was chillingly clear and apparently immediately obvious to anyone who understood these underlying principles of fragility and nonlinearity.
What was the smoking gun?
The report showed that a move upward in an economic variable, let's say a slight increase in interest rates or maybe just a minor dip in national housing prices, led to massive losses, wiping out huge sums of capital on their books.
Okay, sensitive to bad news.
Very. But here's the kicker. A move downward, a favorable economic shift, lower rates, rising house prices, resulted in only small profits.
Ah, the asymmetry again. Big losses, small gains.
Exactly. And what's more, further moves upward, things getting worse, led to even larger additional losses, an accelerating cascade of harm. It wasn't just losing money, it was losing money at an ever-increasing rate as the situation deteriorated.
That sounds terrifying from a risk perspective.
It was a stark revelation of acceleration of harm and what's technically called a severely concave exposure. The expert, upon seeing this data, immediately saw that Fannie Mae's blow-up was not just possible, but practically inevitable. It was baked into their structure.
So the prediction was made years before the crash.
Years before. Despite initial skepticism from industry insiders, people who apparently heckled his concerns and dismissed them as trivial or too academic, Fannie Mae and other similarly structured banks did indeed go bust a few years later, just as this hidden structure predicted.
And the reason wasn't just greed, as often reported.
Well, the analysis suggests the real problem, the root cause, was not primarily greed or even just bad controls, though those might have been symptoms. The fundamental issue was primarily size and the fragility that comes from size, that built-in nonlinearity of loss, that concave exposure.
So the true measure of risk isn't just if you lose, but how much faster you lose when things start going wrong. That acceleration.
That acceleration of harm is the key signature of fragility.
So how do you bottle that kind of profound insight? How do you create a general actionable rule from it that, anyone can potentially use without needing secret reports?
Right. That's where this idea of the fragility detection heuristic comes in. It's trying to create a simple rule of thumb. The goal is to figure out if our miscalculations or misforecasts are, on balance, more harmful than they are beneficial, and critically, how accelerating the damage is. It provides a simple, intuitive test.
Okay, give me an example. How does it work?
Think about traffic congestion again. It's a relatable example for pretty much everyone. Let's say traffic increases by 10,000 cars on a particular highway, and your average travel time increases by 10 minutes. Okay, that's linear so far.
Annoying, but maybe expected.
But what if the next 10,000 cars adds an extra 30 minutes to your travel time? Not just another 10 minutes, but 30 minutes on top of the previous increase.
So the delay per extra car is getting much worse.
Exactly. The system is becoming disproportionately slower. Then traffic is profoundly fragile in that state. This implies you simply have too many cars for the current infrastructure, and you need to reduce traffic significantly until that acceleration of time delays becomes mild and manageable again. The harm from additional cars is not linear. It's disproportionately escalating. It's concave.
I see. So you look for that acceleration of negative consequences as stress increases.
Precisely. And this heuristic applies really broadly, which makes it incredibly powerful. Government deficits, for instance. They're particularly concave, particularly sensitive to changes in economic conditions, especially when government debt is already high.
How so?
Every additional negative deviation from the forecast fiscal balance, say unemployment ticks up unexpectedly or GDP growth slows down more than planned, makes the deficit incrementally worse, and it accelerates faster than you'd expect based on a linear model. The hole gets deeper, faster.
And for companies?
Financial leverage for a company works similarly. As a company takes on more debt relative to its equity, it might need to borrow more and more just to get the same marginal increase in profits, because the risk of bankruptcy, the cost of borrowing, rises exponentially. And with operational leverage companies with high fixed costs, if a fragile company's sales drop by 10%, its profits might decrease by, say, 30% or 40%, much more than profits would increase if sales went up by 10%.
That same asymmetrical vulnerability again. Losses hurt more than gains help.
Exactly. It's a powerful, dangerous asymmetry.
And the expert actually suggested this to the IMF.
Yes, indeed. The expert mentions suggesting this simple measure of fragility, looking for the acceleration of harm to the International Monetary Fund, the IMF, as a potential substitute for their traditional, often poorly performing risk measures.
Why poorly performing?
Because their existing models, often based on linear assumptions or averages like value at risk, simply weren't capturing these crucial nonlinear effects, consistently underestimating the potential for catastrophic blow-ups in countries or financial systems. This really speaks volumes about how deeply ingrained and potentially flawed our current standard methods of risk assessment truly are. They miss the concavity.
Now, here's a rather amusing yet also profoundly insightful twist to this story about the heuristic.
Yes, the reception.
When the expert initially presented this simple fragility detection heuristic, this elegant, intuitive rule of thumb to, say, academic colleagues and quantitative analysts, the quants.
The reaction was, let's just say, not enthusiastic.
Underwhelming.
To put it mildly, yes. Dismissive might be a better word. They visibly scorned it, apparently, perhaps because it was too simple, too intuitive. It didn't seem mathematically sophisticated enough for their complex models and minds.
It wasn't wrapped in enough equations.
The expert notes they did not think of themselves as capable of coming up with such a trivial idea. So what did he do? He collaborated with a brilliant mathematician, Raphael Dowdy.
Okay.
And together, they expressed this simple idea using the most opaque mathematical derivations with the incomprehensible theorem that would take half a day to understand. They deliberately made it dense, complex, and intimidating.
They dressed it up in complicated math.
Essentially, yes. Cloaked the simple intuition in the garb of high mathematics.
And the result?
Suddenly, people take the idea very seriously, and positive reactions followed. The once trivial heuristic was now hailed as intelligent.
That's kind of depressing, isn't it? It highlights a weird truth about how ideas are sometimes accepted or rejected in academia and complex fields.
Yeah.
Sometimes simplicity needs to be cloaked in complexity just to be taken seriously.
It's a bit cynical, but perhaps true sometimes. More importantly, though, this mathematical formalization did help highlight the critical link between nonlinearity, specifically concavity, a deep-seated dislike of volatility, and fragility, using the rigorous framework of option theory to provide that proof, albeit an unnecessarily complex one for the core idea.
But it does raise a profoundly important question for all of us, doesn't it? If these widely used models, particularly in fields like economics and finance, are potentially so flawed because they miss this concavity, how can we possibly make critical decisions based on them?
Especially decisions concerning things like small probabilities, which, as we've already discussed, tend to be fragile in errors. That estimated 1 in a million chance could easily dramatically rise to 1 per 100 in the face of unexpected events or modern flaws.
It's a systemic vulnerability in our very decision-making frameworks. We might be basing huge choices on models that are fundamentally blind to the most dangerous risks.
And this method, this simple heuristic, whether cloaked in complex math or not, can actually help show precisely where the math in an economic model is bogus, or at least fragile.
How?
You simply do a small change in assumptions, tweak an input slightly, and look at how large the effect, and crucially, if there's an acceleration of such effect. If a tiny tweak to your starting assumptions leads to a massive, disproportionate, and accelerating change in the model's output.
Then the model itself is fragile to its own assumption.
Exactly. It implies that anyone relying heavily on that model is potentially headed for a massive blow-up from black swan effects, those unforeseen high-impact events that the model clearly isn't handling well. It suggests that perhaps much of what is taught in economics that has an equation, as well as econometrics, should be immediately ditched, or at least viewed with extreme skepticism.
Which, frankly, might help explain why economics is sometimes seen as, let's say, a salient profession, one that often seems to miss the mark spectacularly despite its scientific pretensions. It keeps getting blindsided by reality.
Because reality is often nonlinear, and the models are too often linear or fail to capture the concavity correctly. The critical takeaway here is to always stress test models. Don't just look at the central forecast, see how the outputs change, and accelerate when you push the inputs around, especially the negative inputs.
Look for the fragility in the model itself. Okay, so we've talked about the perils of scale and that nasty asymmetry of error, how things mostly go one way, late and over budget. Now, let's dive into perhaps the most fundamental and maybe counterintuitive idea of all, the hidden power and peril of variability itself, and why our common understanding of averages can be, well, utterly deadly. Prepare for the grandmother paradox.
Ah, yes. This is truly one of my favorites from the source material. It highlights such a critical blind spot in how we interpret data and make decisions based on simple metrics.
Okay, lay it on us. The grandmother paradox.
Imagine you're told that your beloved grandmother will spend the next 2 hours experiencing a very desirable average temperature of 70 degrees Fahrenheit. 70 degrees Fahrenheit, that's roughly 21 Celsius. Widely considered pretty optimal for comfort and health.
Oh, sounds perfect. Nice and comfortable for Grandma.
And if you're maybe a big picture type of person, maybe someone trained in business school to focus on key metrics and averages, you might be completely satisfied with this summary information. Average of 70? Great. Sounds excellent.
Seems fine. What's the catch?
But here's the second piece of data, the critical detail that the average completely obscures. She spends the first hour at 0 degrees F, that's well below freezing, minus 18 Celsius.
0 degrees, freezing.
And the second hour, she spends it at 140 degrees F, that's a scorching 60 Celsius, like being in a sauna, or worse.
Whoa, so an hour freezing, an hour cooking.
Exactly. Now, the average temperature across those 2 hours is, mathematically, still 70 degrees Fahrenheit. 0 plus 142 is perfect. But what's the outcome for Grandma?
I'm guessing not good. You will almost certainly end up with no grandmother.
Precisely. You'll likely be planning a funeral, perhaps dealing with an inheritance, but the grandmother will be gone. The average was meaningless, even dangerously misleading.
Because the variability killed her.
Exactly. Clearly, temperature changes become more and more harmful as they deviate from that optimal 70 degrees. The crucial insight here is that the variability, the wild swings in temperature, turned out to be far, far more important than the average temperature itself. The notion of an average is of no significance when one is fragile to variations around that average.
So the average only works if the thing you're measuring isn't sensitive to the swings.
Right. This highlights what's sometimes called a Procrustean bed, named after a figure in Greek mythology who forced victims to fit his bed, either by stretching them or by brutally lopping off their limbs to make them fit. In science, and especially in fields like economics and finance, our models often simplify reality by forcing it onto the Procrustean bed of averages. They focus solely on the average, lopping off the crucial information about variability. But this grandmother paradox brutally demonstrates how simplification can distort the situation to the point of being harmful when it ignores the vital aspects of variations and dispersion.
Because grandma's health is fragile or concave to temperature changes?
Exactly. Her health is concave to temperature variations, meaning harm accelerates exponentially with deviation from the optimal point. Small deviations may be okay, big deviations, fatal. The average tells you nothing about those fatal deviations. The lesson is stark. Averages lie when systems are fragile to variability.
That is a powerful and slightly terrifying illustration. It makes you question every average you see.
You should always ask, what's the variability and how sensitive is the system to that variability?
This profound insight leads us directly then to the concept of the philosopher's stone, but in a modern context.
Right. Historically, medieval alchemists sought the impossible to transform base metals like lead into gold. They called this ultimate goal the magnus opus, the greatest work, and they believed the key was finding the mythical philosopher's stone.
The magical substance that enables transformation.
Today, the expert whose work we're drawing on believes that a fundamental property called optionality is about as close we can get to the philosopher's stone in our complex, uncertain world. It's the key to thriving, not just surviving.
Optionality. What exactly is meant by that here?
Well, first, we must avoid a common mistake. Don't conflate good outcomes with good forecasts. Don't mistake the static price of oil today with the dynamic, complex geopolitics that drive its future fluctuations. The true focus shouldn't be on prediction, but on the convexity of payoff and optionality.
Convexity again. So, the opposite of grandma's concave fragility to temperature.
Precisely. Optionality gives you a convex payoff. Think of it as having the right, but not the obligation, to take a specific action, usually to benefit from favorable changes while being protected from unfavorable ones. Like having a ticket that lets you fly if the weather's good, but you get a refund if it's bad. You benefit from the upside, good weather, but are protected from the downside, bad weather.
Okay, so you get the good surprises, but avoid the bad ones.
That's the essence of it. So why does optionality win? Anything with optionality inherently has a long-term advantage in an uncertain world. The truly beautiful and powerful thing about having a convex payoff structure is that you can be wrong in your predictions and still do fine.
How can you be wrong and do fine?
Because your potential gains from being right, or just lucky, are much larger than your potential losses from being wrong or unlucky. In fact, with convexity, the more uncertainty, the better your position becomes, because uncertainty creates more potential upside surprises for you to benefit from, while your downside is capped.
So randomness actually helps you if you have optionality.
Exactly. This explains why you can be dumb and anti-fragile and still do very well. You don't need to predict the future. You just need to be structured to benefit from its inherent randomness and unpredictability.
Can you give a practical example?
Sure. Think about venture capital or even trading in volatile markets. One massively profitable investment or trade out of 10 might more than cover the losses from the other 9 because the potential payoff on that one winner is so disproportionately large. The function of something is very convex. Each win can be 10x, 100x, while each loss is limited to your initial investment.
So the average return across all 10 might be great, even if most were losers.
Right. This hidden convexity bias comes from a fundamental mathematical property called Jensen's inequality. We don't need to dive deep into the complex math here, but the core idea is that for convex functions, the average of the function's outputs is greater than the function applied to the average input. Ignoring this principle means missing a chunk of what makes the nonlinear world go around. In essence, optionality is the ultimate cheat code in an uncertain world. It allows disproportionate gains from random positive events while limiting the downside from negative ones.
Okay, that's the good kind of non-linearity, convexity, optionality, the philosopher's stone. Now, what about the flip side, the inverse philosopher's stone?
Right. This is the hidden harm of fragility or negative convexity, the concave situation, like grandma and the temperature. If you have a concave function, think of something like a square root function, where increases give diminishing returns, or worse, where deviations cause accelerating harm. Then the average of the function is less than the function of the average.
Okay, so the math works the other way. What does that mean practically?
It means this negative convexity bias, this hidden harm of fragility, is that you need to be much, much better than random in your prediction. You need incredible foresight. You need to know precisely where you are going and avoid deviations, just to offset the negative effects of everyday variability and uncertainty.
Because randomness hurts you disproportionately.
Yes, every random fluctuation, every unexpected event subtly erodes your position or causes disproportionate damage. It's like walking on eggshells. Every step carries a disproportionate risk of breakage. With fragility, concavity,
Yeah.
you must be almost perfectly right, almost prescient, just to stay even. Any error is amplified negatively.
So with convexity optionality, uncertainty is your friend. With concavity fragility, uncertainty is your enemy.
That's a perfect summary. This gives us a crucial triad for classifying pretty much anything in the world regarding how it responds to disturbances, shocks, and uncertainty.
What's the triad?
First, there are those things that benefit from disturbances. We call these antifragile, and they possess optionality or convexity. Second, there are things that are roughly neutral to them, robust systems maybe, that aren't particularly harmed or helped by variations within a certain range. And third, crucially, there are those things that actively dislike and are harmed by disturbances. These are the fragile concave systems.
Can you give examples of each?
Sure. Evolution and scientific discovery, for instance, demonstrably like disturbances, they thrive on variation, random mutations, unexpected experimental results, because those provide the raw material, the optionality for improvement and breakthroughs.
Yeah.
Trial and error with small failures and big potential wins is inherently anti-fragile.
Okay, so randomness fuels progress there. What about the others?
Forecasts, on the other hand, are inherently hurt by uncertainty. A forecast is a fragile thing. Its value is destroyed by deviations from its prediction. Complex machines optimized for one specific task might be robust within their operating parameters, but fragile to conditions outside them. Grandma was fragile to temperature swings. Fannie Mae was fragile to interest rate hikes.
So anti-fragile likes noise, fragile hates noise, robust ignores noise, up to a point.
That's a good way to think about it. The crucial insight here is this. If you have favorable asymmetries or positive convexity optionality, you will, on average, do reasonably well, outperforming the average in the presence of uncertainty. The more uncertainty there is, the more that optionality kicks in, the more you will tend to outperform simple linear expectations.
Uncertainty becomes fuel.
Conversely, with negative convexity, with fragility, you are consistently outperformed by linear expectations in the presence of uncertainty. The average outcome will always be worse than you predict based on simple averages, because the negative deviations hurt more than the positive deviations help. It's a profound realization that really reshapes how we should view risk, planning, and even what constitutes success in a world defined by its inherent unpredictability. Prediction is often futile. Structuring for optionality is key.
And that brings us towards the end of this deep dive. Wow. We've journeyed from a multi-billion-dollar bank error triggered by one guy.
All the way to the simple yet incredibly profound lesson of the grandmother paradox.
We've uncovered how scale, while often persinned for efficiency, often secretly breeds fragility because of these nonlinear impacts. Small errors get magnified hugely.
We've seen how errors tend to disproportionately accumulate in one direction, the costly, time-consuming one making planes late and projects overrun, and how relying on simple averages without understanding the underlying variability can be utterly deadly.
Most importantly, I think, we've touched upon the profound difference between convexity or anti-fragile things that actually benefit from shocks and uncertainty and concavity, or fragility things that are disproportionately harmed by them.
And we've seen how these principles aren't just abstract theories. They apply across finance, project management, government policy, technological systems, and even environmental issues. The lessons from a bank's hidden trading risk translate directly to how we should think about designing our cities, managing our global supply chains, and even approaching our personal endeavors.
It's not just a set of isolated facts, it really is a powerful lens, isn't it? A different way to view the world, offering insights far beyond those simple efficiency metrics we usually focus on.
It encourages us to look for hidden vulnerabilities, for that accelerating harm, for sensitivity to variation, rather than just focusing on the projected average outcome.
So, to leave our listeners with something to think about, Here's a final provocative thought. If our world is becoming increasingly complex and interconnected, and I think we can agree it is, and we now understand, thanks to this deep dive, that size and hyper-efficiency often breed hidden fragility. What fundamental changes do you think we need to make? How should we redesign our systems from our intricate global supply chains to our sprawling cities, even our own careers to become truly anti-fragile, benefiting from uncertainty rather than just trying to be less fragile, merely robust?
That's the billion-dollar question, isn't it? Or maybe $1 trillion now. How do we build systems that gain from disorder?
Something to ponder as you navigate your own complex world, hopefully now armed with a new understanding of hidden fragility and the surprising power of optionality. Thanks for joining us on the Deep Dive.